So everybody can see my screen now, so I can proceed. Huh? Can everybody? Okay, good. So let me finish with this markup. Then I can start. So now, this is the highest, this is the previous days high, previous days low. Then we have this particular day now. This is the lowest low right now. I'm coming. This is the previous day's low. So by the time we hit Asian session tomorrow, we are going to know the previous day's high. Okay, so that is for the identification of previous days highs and low. So now let's now switch to session. After the identification, then I'll talk about how to trade it and some mistakes that other people do when it comes to trading it. So I'll be teaching you guys how to trade it with supply and demand. And I'll also be teaching you guys how to trade it alone without supply and demand. So it's now your choice to decide which of it you want to use to trade, right? But at the end of the day, we are still going to add everything together, right? Because there are still some confluences that we are still going to be talking about, okay? So I'm coming. So now, so we have this, we have all this. So now let's go to the session part of it. Then before I even go to the chart, then I will talk about the psychology. So now let's go to the session. So I'm not going to be identifying this session too much because it's going to be wasting our time. I'm just going to like identify for like 2 days. Okay. So use your discretion to know the rest. It's not that hard. So for session, we have, this is Asian session high, Asian session low, right here. Right here. Okay. This is the lowest low of Asia. Then we have London high right here. London high right here. Then we have London low right here. Then we have New York high right here. And we have New York low right here. New York low right here. So that's just how to identify session highs and lows. So I don't want us to waste much time on that. So now let's go back to my board so I can explain 1 or 2 things. So now, going back to my board, yeah, let me now explain. Time, it is that. Finishido survive. So now let's talk about let me now talk about what liquidity is and why, because if you understand the logic behind liquidity itself, then you'll be able to like understand why we are trading it this way, right? Because there's a lot of misconception that people have. They feel like if this point is a liquidity area, let's say it's a liquidity point, they believe anytime market grab liquidity, it needs to reverse. No, it is not necessary. The purpose of liquidity is to be grabbed. It is not to cause reversal. But there are some certain scenarios whereby that liquidity would require market to reverse. That is, if that liquidity is an inducement liquidity. Now, let's say we have a session high like this. Pay attention, guys. We have a session high like this. Session high, session low. Now, this one, we anticipated that this guy is an inducement. Why? Because the rule of break of structure is that market needs to, the volume of the existing swing, pay attention, the volume of existing swing must not be stronger than the volume of the break of structure. So look at how this guy is moving impulsively. Look at how this one is moving impulsively. Look at how this one too moving impulsively. And you call this a break of structure, and it is this slow. That means this is not valid. So this guy is an, so the fact that it is not valid, the next question you are going to ask yourself is, if this is not valid, then why did they now try to break structure with this type of price action? Funny enough, it can even break through structure. I'm going to still explain something. It can break through structure, but they are still going to clear it. But this same diagram again, it can break two structures and they might not clear it. Let me bring it down for you. Let me break it down for you. I will tell you why. Don't scatter your head. So now we have high, low, high, low, high. Then you have this. Structure 1, structure 2. The same thing here, the same thing. Good impulse, good impulse. This is weak, this is weak. But this one, this is an inducement. But this one will get here and sell. But this one, they will clear it. Why? Looking at this one here, the reason why I'm explaining this immediately is because I don't want a situation whereby it will be like, but Kama said, it's all about price action. Now, this is an inducement here. As a result of the rule of break of structure, the volume that broke the structure needs to be stronger than the volume of the existing structure. That is the rule. So which means if we want to draw the real break of structure, it should be high, low, high, low, high, low. Then you have something like this, then boom. So which means this volume is stronger than all this volume. So this is a valid break of structure, and it broke two structure. But this one did not do it, this one did not do it. But Kama still said this one would sell. Why? It is because we have swing low, swing high. I've explained this before. Swing low, swing high. Demand, break of structure, inducement. Some people tried to, because when we have this high, low, high, some people wanted to buy this. A lot of people, basically, we have high, low, high, low, high. Market broke structure. People that are getting from here are happy. Let's say liquidity 1. Some people saw break of structure right here. They set their buy limit right here. Buy stop. So it can buy. Once it gets to this area, it will keep buying. So that's two types of liquidity. Some people wait for retracement. That's liquidity 3. Some people will draw trend line right here. Liquidity 4. A lot of people are stopped here. They feel like they are right. So all of a sudden, the market broke. So which means there's a manipulation here in this violation block. Right? So having that manipulation, this guy would sell. Now, compare it to this one that I said they will clear. But once it sells, Don't try to mitigate it because it will come here, sell a little bit, rally up. They will clear the whole thing. Or probably even come like this, act like another inducement, come lower, take it off, a new A, B, C. Then they will come, take care of this one, then buy. Okay. So now, but why did I say this one is going to fail? Now, you can't call this guy a valuation block because it broke structure first before pulling back to mitigate this order flow. So which means everything here is a mitigation candle. So which means this is an inducement point. So which is, Kama said, every swing point now, this swing point can now fall inside one. Swing point criteria, swing point, which is obvious, this is a swing point. 2, it can actually be previous day's high. We can't tell. I am not the one that will tell the price to locate itself there. 3, it can actually be previous session high. 4, it can probably be previous week high. Right? There's still a particular one I'm supposed to talk about, but that will be in the next class. Okay, I don't want to like scatter the whole thing. Now, it can be any of these things. No, this one is not even there because randomly, this is a swing point, right? So it can be this, it can be this, it can be this. All of them, the reaction you will be getting from it is going to be the same thing because liquidity is liquidity, right? But knowing the fact that they can be in different dimensions is what you should focus on. So now, knowing that you have this inducement right here, the question now is, how would you know that, okay, this is an inducement? As a result of probably previous day's high, previous day's low, blah, blah, blah. How would you know that it would sell? That is the major problem that people have. That is why I said it is in 2 ways. There's a situation whereby you will see me pick a trade directly from this. Pay attention, guys. This thing is not hard at all. Like I even say, this is one of the most simplest way of trading. Now, you will see me sometimes do this. And I will draw something like this, a line. Then I'll wait and I'll pick my entry directly from here. From here. Sometimes, this is our inducement. We can tell based on the drawing. Liquidity. All these things are just trap. The market will take out this what? This trap. You will see me pick entry directly from here. Directly. So people will be like, how do you get it? Okay, I will explain everything. And sometimes you will see me do this. The same scenario. Inducement. This. Boom. Then you will see me wait for a change. And sell off. I won't enter directly. So now, this is the possible 2 ways that you want to get in. It's either getting in directly or getting in with a confirmation. So now, let's start from getting in directly. What is the characteristics that will make you get in directly? Now, you spot your inducement, your liquidity. But that liquidity, this can actually be a previous day's high. Just this. And this can be the previous day's low, previous day's high. You can't say you want to sell from here. Why? Because this guy is not an inducement high. It is just a previous day's high. So it is nothing to you. So what I'm trying to tell you is this is a game of confluence. Previous day's high, session high, previous week high is invalid to me if the I is not responsible for the creation of an inducement. And what is inducement? I have explained it, but I will explain everything over again using this. Now, I can't just have this and expect this guy, they should grab it and sell because it is previous day's I. Or because it is previous session I, they will just grab it and sell. No. Because if a point is a previous day's I, what does it mean? Let me start from there with you guys. Let's say market has been selling like this now. And this is the previous day's I. And market does this. Previous day's low. Why does this matters? And why does this matters? Is because put yourself as a hedge fund. And your purpose is to grab liquidity. Once you enter the market, where would be your main focus? Your main focus will be on the swings because you want to focus on the major money. And focusing on the major money, you know that everybody that sold this particular day are being trapped from this high to this low. And everybody that bought have been trapped from this low to this high. So will you be interested in all this internal thing? No. As a big boy, you'll be interested in, because you know that once this high is being taken care of, every people that sell this thing, they have been stopped out. This guy has 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 been stopped out. All of them have been stopped out. You can't just go and just take this particular money here, leave this one, or leave this one. You will target the whole point, right? And targeting that whole point, what would not aid the price to reverse? It is now the don't let me give it a name. Let me just say it is now inducement plus inefficiency. Because now, what is inefficiency? What is an inducement? I've told you, inducement is just you knowing that something would sell, but it is not going to sell. But you can't call it an inducement without a particular incomplete price action. What does that mean? Let's say you have high, low, high, low, high. Market broke structure. And it is supposed to come back and do break and retest right here. But all of a sudden, the market came here and it started to break structure. You can tell, based on the rule of break of structure, this is not an LD push, number one. But why would price get close to mitigating this guy, but ignore it, then break a new structure, creating an inefficiency here? Which means this inducement plus inefficiency would make market grab this liquidity and sell. But if market do this, high, low, high, low, high, then it broke structure perfectly. It mitigated perfectly, and it sell off without a sort of an inducement, without a sort of an imbalance here. And let's say it does not even break structure perfectly. Wait, it does this. No, sorry. Sorry, guys. And we have this break of structure, then it pull back, and it started coming like this. Based on the rule of what? Of break of structure, you know that this push is not LD, right? But based on the rule of pullback, you know that this push has passed 50%. But something is still telling you that this guy is liquidity because, number one, it does not mark the criteria of an LD push. And or let's say it is a swing, external liquidity. Or let's say it is a previous session. Or let's say it is the previous whatever. Now, you are not questioning yourself like, and there's no imbalance here. What will I do in this type of scenario? Because imbalance will have tell you that, okay, for market to stop here, and ignoring this imbalance here, what would have made me, why would I now call this an inducement when there's not an incomplete transaction here that it is supposed to fulfill? Because like I told you guys, imbalance is as a result of an incomplete price action, right? That market has to come back to fill before continuing its direction. Because if market leave an incomplete price action here and it broke structure here, they are trying to induce people come back for the incomplete price action and move away from it. But this one now, no incomplete price action, everything is perfect, but it is still previous session high. So what will you do in this scenario? That is where this comes in. And this now, you will now look it as an angle of what? Of this guy as a swing point, which is market will come there. I will draw the possible scenarios for you. Market can come there like this, break structure, right? Then what? Causing an inducement for people that wants to sell, making them feel like, oh, this is a valid sell. Now it comes, react, take them out. After taking them out, this guy has become a flip zone. But remember, you are looking to sell, but you are not sure yet. So what would you do is simple. You wait for this violation block to be flipped back to your direction. Then that is when you get in. That is why this thing that does not have a fair value gap is the reason why I cannot get in directly. There are some people that would have this trade like this. High, low, high, low, high. Then they will have this. They will have this same drawing that I drew here. Sorry. They will have this same high, low, high, low, high. Break or structure, pullback. Then they will have this. They will just mark this guy. Then they believe that this is an inducement. Then this would be their Quasimodo, right? And they want to pick entries from here. It is good, right? But this trading system, like, is actually, there's a big mistake there, because you can actually have a good win rate with it. That is so clean. But what if there's another better way you could have reduced your loss just by waiting for an order flow to direct you to the perfect area? Because once you can spot an imbalance here, then this is most likely not to be an inducement, because once you can spot an imbalance, that means this is a mitigation, and you don't want to trade from a mitigation point. So if you don't have an imbalance, then that's just simply like you have something like this: break or structure, pull back, sell. So why would you say you want to call this an inducement and you still want to sell without declaring this high? That is dangerous. So rather, instead of you thinking, market cannot just come here and fly. Sometimes it does that too. But trust me, that is where your lower time frame comes in. Because if you understand, if something is telling you out of what I've told earlier, that this is an external liquidity or this is a previous session liquidity, if you have seen it and your discretion is telling you that this market will sell, but you can't spot an inefficiency here to tell you that this is an incomplete price action. Remember, I told you that we have two types of pullback. The one that does not pull back to up to 50%, market will come back and clear it. And the one that pull back to 50%, but did not feel imbalance, which means market will come back to feel that imbalance and sell. If this has an imbalance, yes, you can sell from it, right? But if this does not have an imbalance, you would look at this price action as a single move, which means you would have high, low, high, low, high, break of structure, pull back, another break of structure. Then this is a supply. That's how you will see it. But you know that this supply, to you, it is a trap. But this is your own real supply, even though you can't spot any other block there, or you can't spot any imbalance. Now you wait for price to come, react from this one, clear it, flip it back. Because clearing of this particular supply makes this guy a violation block. So flipping it back makes it a double flip. The market will come back to reclaim it then you can get yourself from here. So what time frame are you likely to see this price action? It is a lesser time frame. If you spot this on 30 minutes, you would be only able to see this price action on 5 minutes. That is why I tell people that you don't just come online and say lower time frame is this or that. There's a way to use it that a lot of people does not just understand. They feel like if you say you trade lower time frame, it simply means you stay on 1 minute and start to look for entries. No. I am just lower time frame for me. It is a confirmation entry. It is a confirmation time frame. Not just I'm looking for setup there. No. It is a confirmation because I know that if this market actually wants to sell from here, it will not just fly to heaven. I'm going to tell you all the different types of way you can get in from here, even without using this one. I'll be explaining everything, right? So you have to be smart. So in summary, right, any type of inducement that you have, if it does not have an incomplete price action above it, if it is a previous day's high, previous day's low, then you have to wait for a sort of confirmation to validate it. Market needs to what? Distribute. Market needs to distribute price. Because what is distribution? When I explain Wyckoff, distribution is a process whereby market wants to sell low, it will now come. You have your POI, it will come. Break structure first. Fake people, take them out, break real structure, then sell off from it. This is a distribution. You don't need a POI for it. But why would you need a POI? It is only if you cannot spot a POI. If you see a POI there, why would you have to ignore it? And what is a POI? A POI has to be a point that invalidates a particular structure or that takes out a certain liquidity that has an imbalance, that it is not filled. So if I have an inducement above a clear POI that has an imbalance, then I might not wait for confirmation. I will sell directly because I already have a point of interest to tell me that this is a true inducement. Because why would you get close to my point and you would ignore it? That is why I can sell from here. But when you can't spot anything that makes sense above your inducement level, which is your previous day's high, your previous day's low, your whatever. If we call something an inducement, we expect price to come, clear that thing, and go to that direction back. If you call something liquidity, you expect price to do what? Clear it, and it can keep going. That is why we say we target liquidity points as a trader. We target liquidity points so that market, because let's say market has done this on good now. Let's say market has done something like this on good. And on this low, you have equal lows, several equal lows right here. And market has come up. And market gave you an order flow right here. What would you say? You'll be like, oh, there's a ton of liquidity here that market needs to grab. So you will use this liquidity as a target. Not after market taking this liquidity, you'll not be looking to buy. No, you are using it as a target because it is not an inducement point. It is just a clear liquidity. So for you to call a point an inducement, something must have been telling you that they are trapping someone. Inducement means trap. So it is now, am I taking trade directly from this inducement point, or I am waiting for a confirmation? When would you take trade from it directly? It is when you see a order block above it that is unmitigated, or fuck the order block. It is when you can spot an inefficiency of price. That is what is going to give it out to you and be like, oh, for them to ignore this inefficiency, that means this is a true inducement. Then I can sell from that inefficiency price once they make it efficient. Once this one closes, then I will tell you the different, like 5 ways to get in on an inducement point without a point of interest. It is very simple. See, you don't need to cram liquidity. Just know that the same thing that you would do when they grab session liquidity, It's the same thing you would do when they grab previous day's liquidity. It's the same thing you would do when they grab external liquidity. It's the same thing you would do. It's the same reaction. It's the same reaction, nothing different. But I'm going to explain the ways you would get in and how you would know that you need a confirmation. Okay, look at when we went to the chart now. Is it every previous day's high that the market reversed? No. Is this everyday low that the market reversed from it? But some people will tell you, once market gets to previous day's high, you sell from it. Whoa, you blow your account. Is it every external liquidity that the market reversed? No. But anytime market wants to reverse, there must actually be a characteristic. Something would be there. Something will be there. And those are the things that I'm explaining. It has to have an inefficiency. It has to have an incomplete pullback. It needs to have an incomplete pullback. If it does not have an incomplete pullback, then it is just nonsense. It has to have an incomplete pullback. It has to have things that I've explained previously. It's not as complex as when I say simple, people will come from me like, finance is not simple. Shut up. It's because we complicate things for ourselves, and you will still be feeling like the black. Like, I don't even understand. It's just people just rather come online to like bash some certain strategies when they don't really understand what actually takes. Lower time frame would save you from unnecessary stop loss. And I will now tell you, when you get to the risk management of things, I will tell you what some people are even doing wrong. Because I will get in on a lower time frame, but I will not put my stop loss in a lower time frame level. Once you get to risk management, I will explain that to you. A lot of people don't know how to use these things. You just hear when people say, I'm a lower time frame trader, they feel like you are trading, you are stuck on 1 minute time frame and you are looking for trades there. No, lower time frame is what we call what's I see for here? Karma senior brother. I don't die. Who be my senior brother for here? Who is my senior brother? So you just have to know how these things works. People will just come, talk things, I'll just laugh. What you don't know. See, I have been trading this trading style for like 4 years now. I can even show you my throwbacks. You will see that using small stop loss, blah, 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 has always been my thing. So there's nothing anybody wants to tell me. If it is not working for me, I will have changed it. But there's a lot of things that people don't know. There's a lot of things people don't know. It is not hard. You know, when you pay somebody for mentorship, some people feel like because you pay them, probably there's some magic they want to teach you. No, there is not. But some people will feel like because they collected big money from you, they would rather start picking big English and all. They are just wasting their time. Yeah, I will tell you exactly what I do, how I do it. It's left to you to use it. If you like, go and be looking for what is not lost up and down. Okay, so the third session now, I'll be explaining the different types of ways to get in. Then we are going to go to the chart to look for chart examples. Okay, I hope I am making sense, guys.